You're on, girl.
Good morning, everyone. Thank you for joining us. Oh, that's a good start on this lovely September 20th. Mortgage Pros 411 with Kevin Casey and myself. And we are joined today by Paul Chandler, who is the Grand Poobah at Property Sciences, and Michael Simmons, also the Grand Poobah at AXIS Appraisals. Michael has a couple of different titles. I'm never entirely clear of how I should introduce him or how I should say it, but bottom line is they are the head of these very, very excellent AMCs and longtime veterans in our industry.
And advocates in the industry.
Great point. Advocates. That is the best part. So let's start with we have a few announcements. Kevin, you were in charge.
We do.
Oh, yeah. You're in charge. You're in charge.
As people are rolling in, by the way, 400 people registered today, so that's a good day. So
appraisals, hot topic.
Yep. So we have this week, we have North Bay Camp has a non-QM event, and it's going to be in Santa Fe. Well worth joining. We went to the one last year. It is at another loan officer's business, but it is where AXIS used to have their holiday party, the exact same location. Just is missing the pool tables. I don't know what they got rid of the pool tables for, but hey, it's a good location.
They probably have time to play pool right now.
You do is you go downstairs, get a drink, come upstairs, watch talk to the non-QM people, and they do a good job. They have different non-QM lenders, and they're going to talk about different segments of it. And then this Thursday, Audrey and I are teaching in Southern California in Greater Ventura at the Greater Ventura Camps location in Thousand Oaks. So we're going to do non-QM and reverse mortgages and a bunch of other stuff. That's
Kevin, is there a lesser Ventura? I'm just curious.
I've been looking for it. I haven't found it. It's probably small.
Sorry, just curious.
Yeah, interesting. Question. Good question, though.
We'll do some further investigation.
Then we have Las Vegas NAM coming up, Columbus Day weekend. So that'll be interesting. Probably see you there, Michael. You there, Paul?
Sounds good.
Yeah.
Do we celebrate Columbus Day, or is he on the naughty list now? I don't know.
Yeah, no, we still celebrate it in the mortgage world.
All right, and we have a bunch of other NMLS classes coming up. So Sola has two more. I'm teaching them October, November online, by the way, and then Sausalito. When the heck is Sausalito?
Yeah, Sausalito. That's October 24th.
Oh, Monday. It is? Okay. Yeah. All right, great. So
I signed up. Yes, I signed up.
Yeah, no, a whole bunch of people already signed up for that one. That's good.
Never forget that Michael Simmons is also has an NMLS number and does his head every year. Okay, so with that being said, let's get this show on the road because the list is long of things that we're going to talk about. And it is some of this stuff is really complicated. As much as we talk about it, it's still complicated. So I may interrupt you at certain points to just clarify certain things. So, I know you're ready for that for sure. Just remember, guys, that tomorrow is Fed Day. Tomorrow we are expecting 75 basis points, definitely. But the most important part of tomorrow is not the 75 basis points. It's the Fed comments. Those comments drive the market. It has been so volatile. And our little ditty that we do, Kevin, do you want to sing it?
If you see a rate you like, lock it in.
That was okay. If you want the tune to go with it, if you see a rate you like, lock it in.
Yeah, I'll let you do all the singing.
Oh my gosh.
Hey, coincidentally, as pointed out by Kevin Peranio, tomorrow is also the fall equinox. So maybe this is the last of the rises because, after tomorrow, everything gets darker. And maybe.
Okay. I'm going to say no because we're going to have another crap inflation number for September because last year the inflation number in September was really good. And so we're going to be replacing that with this year's September number. And the expectation is for it to be higher, which is going to continue to roil the market. So guys, just hold on because we got another month of this at least, and then it might level out a little bit. We'll see. The 75 basis points tomorrow should help a little bit. It certainly did when they've done it previously, but it really is dependent on what the Fed says tomorrow because that drives everything. So anyway, so hang on to your bootstraps. It's just more fun. Lock those loans. Do not, I mean, you have more to lose than to gain for sure. Just keep it going. So
actually, I want to add on to that. This is sort of a comment I read the other day, and that was about where the Fed will stop. And it's where inflation is, because the Fed rate ultimately has to be higher than inflation. And it seems to me the consensus is that the inflation number will come in somewhere in the fives. So I think that's when the Fed will stop rising, is when they get the rates over the 5.
Okay, bite your tongue. That is just some, ugh. Okay, let's hope that isn't the case. It certainly hasn't been the case, you know, anyway. Oh God, when he starts saying that, I want to put him in timeout. He might be right, actually. I sure as hell hope not, that's for sure. So there is one more thing I want to mention before we dive into this, which is there is a proposal from Fannie Mae to bump the loans that brokers do, have a 15 basis point hit to pricing, just for brokers. Are you getting that? Just for brokers. And they're saying it is based on the algorithms that are showing them that loan performance and the quality of brokered loans is lower than other loans. I, again, question the algorithms always, because so often, you know, they cite the algorithms. The algorithms are not transparent at all. They are completely a secret. They're supposedly proprietary. I think we need to ditch proprietary and make it so that they have to show us how they're coming to this kind of information, right? Because I don't believe them. So with that being said, MBA is on this, NAM is on this, Mortgage Bankers Association, National Association of Mortgage Brokers. They're all over this. They're trying to figure out whether, you know, how it needs to be broached, but certainly it would be absolutely not good for brokers to have this go into effect. There is a lot of questions. It's very unclear about whether it's both Fannie and Freddie, because why would one, you know, channel have worse or better wholesale loans than the other? But anyway, so stand by, guys. We're keeping an eye on this. And if there is a call to action that we see that should be, I think MBA either did one or is working on it. So we'll keep you posted on that. Okay.
You know what would be nice to know, Audrey, on that topic is, you know, if that statistic is being put forward as the wholesale channel requires 15 basis point add-on, are there different wholesale lenders that are different, right? Maybe all of those losses are coming in for 2 or 3 different major wholesalers. And that's information I think we would all love to see.
Yeah. And also, is it just a bunch of baloney? Because there has been a push to get rid of brokers at the federal level since the SAFE Act, since Dodd-Frank, right? They were, the whole fault for the meltdown was dumped on the broker's head, which was not.
Actually, I thought it was just your fault, Audrey.
Okay, really? Is that what today's going to look like, Kevin Casey? Because if it is, it's going to be a long hour. Anyway, so
Audrey, Paul makes a great point. I didn't want to interrupt you, but before we dive into the appraisal piece, one of the things I'd like to remind everybody is that Fed funds really have only an ability to impact short-term borrowing rates. So simply, if we're in a 5 or 6% inflation rate, that doesn't necessarily mirror where our mortgage rates are going to be. They're not connected in that particular way, and we can see lower mortgage rates sooner, even if the inflationary burden on our economy still is delivering pain points.
Right.
If it looks like influence, but
if they look like they'll get inflation back to where they said they would, then yes, I just don't personally see it. But
okay, so let's look at that just for a second, since you know our appraisal gurus have brought it up anyway. So Q1 GDP was down 1.6%. Q2, we have one more look at it. There's 3 separate looks at each quarter's GDP. Just remember, we talk about this a lot, you guys. And we still have the 3rd one to go, but currently it was down that was 1st quarter. 2nd quarter was down. 3rd quarter, they're expecting, it's been interesting because the Atlanta Fed has been slashing their expectations for 3rd quarter GDP. So, and very quickly, by the way. So August 30th, they said they thought that 3rd quarter GDP was going to be positive 2.6%. By September 10th, 10 days later, they had slashed it to 1.3. That's half. Now they are expecting it to be 0.5. And so I just find it fascinating because, you know, again, we've got this huge Fed mechanism at work where you've got the 12 separate Feds and the governors, and then they come together and there's this huge staff and billions of dollars, and they come up with these estimates, et cetera. And to have them slashing it that quickly is very interesting, I think. So, all right, so let's get into the appraisal part, because the algorithm idea and question that I have around, you know, how are you coming up with the idea that brokers are doing lesser quality loans? It takes us to a question I have in the appraisals, which, you know, this was Paul's focus for a long time, is the AVMs and the algorithms that go into them. And it was only recently, because of my conversations with him, and sometimes arguments, by the way, where where, you know, you have to really think, who's coming up with these algorithms and what do they look like? Are they accurate? Are they not accurate? We kind of, we're fed this algorithm idea, and we're supposed to just go, oh, the algorithm said it. But you know what? Who's making the algorithms, and are they accurate? So let's talk about that for a minute, shall we? Because there are huge changes going on in the appraisal space right now, huge. And they will end up trickling down and impacting not just us, but mostly our customers. So how do we deal with that? So let's talk algorithms for a minute, guys. Thoughts? Here we go. Here we go, Paul. Practice your smiley face.
Wow. You guys want me to go first on algorithms?
Yeah, let's go first, and then Michael can clean it up. How about that?
Yeah. So, you know, Audrey's referring that I've spent a lot of my time working on algorithms the last couple of years. So for those of you who may not know, I was appointed chair of a AVM task force looking at the current generations of algorithms and how.
And I'm sorry, who appointed you, and what chair of what committee, Paul? Be clear, because it's very, it's impressive.
All right, appreciate it. Well, so the Appraisal Foundation, which is authorized by Congress as the developer of standards and qualifications in the appraisal industry, has two councils. They have one council that they call the For-Profit Council, which I belong to, called the Industry Advisory Council. And that is comprised of stakeholders with an interest in appraisal, including many of the largest banks, data and technology companies, and appraisal management companies in the country. That's the Industry Advisory Council. And then they have a nonprofit council, which is all of the trade associations. NAM is part of that. Audrey is going to be the representative on the Appraisal Foundation for NAM coming up. So those two councils provide guidance to the Appraisal Foundation when they're in the rulemaking process for standards and qualifications. We do not have, the foundation, nor does any organization really have any oversight over algorithms of any kind in housing finance and much of society. It's a big topic constantly. How, you know, where can these algorithms be used safely and transparently? So many of the stakeholders saw the appraisal waivers continuing to grow, and they said, you know, it's time we look into this and see exactly a little bit behind the curtain of the algorithms. We started a task force. I was appointed the chair of this Industry Advisory Council task force, and we brought stakeholders together. We brought most of the leading automated valuation modelers on the planet. So Bank of America participated with us, Wells Fargo participated with us. Zillow became the co-chair, who probably has the single largest database and has spent the most money on their algorithms over the last 10 years. They participated, as well as a company called AVM Metrics, which is the leading testing and auditing firm in the space that signs off all the algorithms that are being used in housing finance today. I want to say AVM Metrics is probably signing off on over 80% of those models in the marketplace. So we had the best and the brightest in the space. AVM Metrics had recently produced a paper indicating that the models that are currently used in housing finance are dramatically overestimating their accuracy. So let me say that again. The leading testing firm in the space, along with some professors, indicated that the models are dramatically overestimating their accuracy, sometimes in the percentages of 50 to 70%. So if they're saying we're within plus or minus 10%, they're really plus or minus 15 to 17% in the models. That's AVM metrics. Zillow, just before we started, they produced a paper and said the models are highly uncertain. They tested all the competitive models. They looked at how models relay confidence scores to users and lenders. There's no consistency. Some people say, well, red, yellow, green will give you an idea as to how models are going. Some would use a number from 0 to 100. And those indicators of confidence are not tied to any really standardized math, which is surprising given the fact that these are all math models at the end of the day. So there's growing recognition among the stakeholders and the regulators who we have been advising recently. The purpose of this task force, by the way, was to make recommendations to the federal regulators so that the federal regulators could implement the provisions of Dodd-Frank that said that AVM models should have standards. After 12 years now, no standards. I understand it may be the last single piece of Dodd-Frank legislation that has never been implemented. And you can ask why it hasn't been implemented, but it's mostly because it's just hard and there's not a real consensus around how to do it. It's so embedded in the whole mortgage process that we can't really get away from it. That clearly there are benefits of AVMs, and most people think I'm a huge AVM. I'm negative on AVMs, but actually I love AVMs. They just need to be transparent. They need to be fair. Everyone needs to know how to use them. And most importantly, the homeowners need to understand when they're making important decisions, is there accuracy around the AVM and can they rely upon them? So with that as a backdrop, not all is well in algorithm land in housing finance nor America. And I like to say, if we can't get it right in housing finance first, the most important systemic industry on the planet, we're not going to get it right. So hopefully as a group of industry stakeholders, we can work together to get this correct.
Well, and first of all, I would just like to say that Paul has come a long way in his delivery of said message. So well done, Paul. That was fantastic. Managed to crack a smile every once in a while. He didn't cry. It was all good. I didn't
no cursing.
I did not want to kill him. It's all good. But the point here is, it's one thing to be off on your value a little bit when you have 30% appreciation year over year. It's another thing if we're back down to somewhere between 1% and 5%, right? And so the example that was given by Paul and Michael when I was speaking to them, which I thought was really an excellent example, is somebody goes in, they have accepted that the value given, accepted by DU or LP through the automated model was accurate. They don't need an appraisal. And so let's say it's off even slightly, let alone to the extent that Paul says that the studies are showing, and they need to sell a year later. And now they're going to be upside down, so again, it's going to be an issue if they need to come up with 6% closing costs for the realtors and then whatever else is on there. So it is something that we as LOs need to be aware of and be thinking of as far as accepting AVMs as the, gospel truth. I know that I personally, on a rate and term refinance for me, I'm like, whatever, if you're a 20% LTV, and this is where Paul and I have kind of gone in circles occasionally, one of the reasons, but if you are dealing with higher loan to values, and again, there's that much of a disconnect between what someone could sell it for a year later and what they're paying for, it could be a huge issue, right? So again, transparency and algorithms, I really think overall, this has been very much in my head this morning. We really need to push for that in the mortgage industry, and not just for appraisals, but for the underwriting guidelines, for the LLPAs that they're dumping on everybody's head, where they're saying, okay, you have to pay this is my favorite, 3/8 extra on a cash out refinance, but your LTV is 20%. I'm like, really? There's more risk, you liar, pants on fire. So anyway, it's a huge deal. So Michael, any thoughts on this?
So Paul is exactly right.
Yeah.
He's just exactly right. And that's as good and concise a definition as I've heard of great. Any of that at all. The crusade that he's been on has been, frankly, kind of a thankless task because it's not generally appreciated. AVMs are a huge tool. They sit at the nexus for everything that happens around waivers. And I made these arguments before that when your borrower wants to put 20% down and they're gifted with a waiver and they don't have to pay for an appraisal, you don't have to wait for the time because it takes all of 15 seconds for that decision to come across the wires. The decision is that Fannie and Freddie will buy that loan because they feel that there is enough risk reward in making that loan. It has nothing to do with the value of the property. And if they're off by 15 or 20%, then technically the borrower wouldn't have any equity in the property if they had to resell that property, but that's not their problem. Their problem is, are they going to get repaid? So they will argue that that the information is much deeper and much more complete, and it's just not true. There are 4 elements in a waiver. One is collateral. The other 3 are income, credit, and assets. Right. And they're the 4 elements that trigger the decisioning there. And collateral is only a small part of it, and the one that's mostly risk weighted. So
very interesting.
Yeah. So I just have concerns about that, and all of you who are successful in business have a relationship-based focus with your clients, and you want your clients to be around a long time, and they deserve to know whether or not their investment is being protected and what that value of that collateral is. And frankly, the algorithms that Paul talks about, good, bad, or indifferent, are useless without current information. And the more you take the appraisal process out of that database, the poorer your algorithms are going to perform because they're just dealing with back-looking information. So,
right. Well,
that's my little rant.
So that I think you're totally right on this. And again, it's one thing when things are off the charts, you got buyers falling out of the sky, and it's just a non-issue to go way over asking price. But when we get back to a more normal market, we need to, as thoughtful, caring LOs who want our clients to be healthy, safe, and sound in the future, we need to be looking at this. And so, all right, and have conversations with your clients. What is your plan? Where are you thinking you're going to be? And also remember, those plans change in a blink of an eye, right? So again, we have to be more aware of this. And so it is really a tricky subject, because again, there's so many people, and I know that I've fallen into this too. You're like, all right, I got an AVM. Awesome. It was the conversations with you guys that made me really understand that it has a lot more to do with the whole overall risk profile, and that is not just the GSEs or Fannie or Freddie blessing that value, saying this is correct. And so that's what we need to remember.
That's a great thing to tell to the borrower too, is say that, hey, Fannie and Freddie think you're such a strong borrower.
Yeah.
That the value of the house is not as critical.
Yeah. And some people aren't going to want to hear this, frankly, because it's going to throw a wrench in their business model, and they don't want it to be harder. But again, we have a little more flexibility now than we did 6 months ago in terms of our buyers are not competing against 50 other people. You don't have to waive every single contingency. You don't have to close in 10 minutes. You have time to do your due process, your due diligence, to make sure that your client is buying a property the property they think they are, right? Yeah. Paul, are you satisfied with that?
I am. And I think, Kevin, you hit on a little bit, is that, all of the discussion is around the risk to the lenders and to the GSEs, right? They have credit support, they have income support, that sort of thing. And all of that is good lending, and that's what the lenders should be doing. Now, the securitized market's a little different because of the sale and, you know, the release of liability and those sort of things. It adds all sorts of, you know, other consequences to the process. But the homeowner, because the home is the most important asset for most Americans, the more we can do as their servants, as their mortgage professionals, as the appraisal people serving the mortgage industry, the more we can do to help them better understand that, that's our job, right? That's why we're here. It's our community, it's our neighbors, it's our customers. Right. And the more they understand their value, the better. Because if they go into a transaction, even though the lender tells them your credit's great, no problem, sign here, you've got the loan. In their mind, their personal well-being is tied to the equity in their home. And we've got to make sure that they understand that it's maybe not as represented by the algorithm. And here's better ways for you to understand that, right?
Right, exactly. It's you know, my aunt always pops into my mind. So my aunt was buying a place. She was moving. She had moved away, shouldn't have, and wanted to move back to a certain neighborhood. She was putting down like, I don't know, 80%. So she was going to have this teensy tiny little loan. She couldn't have cared less whether we were above or below the purchase price by a few $1,000s. It didn't matter. She just wanted to live there. And that was her point. So we're going to have borrowers like that, and they're going to be fine no matter what. But the people who are putting down smaller amounts of money or even a bigger chunk, and they may have to move down the road, or they don't understand that the value isn't being blessed, like you were saying, it's the overall risk package, which I was not clear on, honestly, until
I was not either.
And so I think that that's something that we will look at, the people who are thoughtfully looking at their borrowers' overall health and picture. We will be more aware of that. And again, back to the point of the studies have shown that the average renter has $1,200 in assets and the average homeowner has $250,000 in assets. I mean, owning a home is the path to having some sort of family wealth.
Yep, absolutely.
But we have to be watching it too and making sure we understand the whole thing. Okay. And so when I go off on loan officer speak and Paul doesn't agree with me, he starts calling me sweetheart. He hasn't done that at all today, which must mean that things are going well.
I really
yes.
like you, so stop it. Okay.
Yeah, right. Okay. So, so here's another thought that popped into my little head this morning. You ready? So I have heard of an appraisal where it was marked declining market, right? Which can kill your deal. So here's my thought on this, because again, you know, if we take a deep dive into into subjects that we have not explored so much before, it never really occurred to me to ask, how does someone decide whether it's a declining market or not? I mean, so are the appraisers like part of some informational group that they talk to each other, they study reports, they are diving into the economic statistics? Like, is it very scientific, or is someone just pulling that right out of their, let's hope it's the ear? And so I would like, I want to take a little dive into that, because if you've got an appraiser who's decided it's a declining market versus it being a declining market, you know what I mean? Like, how does that go, guys? Who wants to go first?
Michael, Paul's the appraiser here. That should be his lead.
Yeah. So, I mean, declining market topics have been around. You know, the last recession became big, right? So it's at what they would call regime shift, when markets are moving from generally increasing over time to stabilizing and maybe starting to trend down, right? And so how do we as individual appraisers, who most of us look at very small markets, right?
Right.
You know, I work in Contra Costa and Alameda County maybe, or I work in, you know, Dade County and a couple other counties, right? And so we don't have the same global perspective of other markets. Most of us, we read things, maybe we subscribe to services that help us understand that. So back to the algorithm thing for a minute. The agencies, the GSEs could do wonderful data. You know, they have all the data that kind of looks at where things are. There's where algorithms can really help the appraisal community, right? Show a lot of data, show what's trending. And then it maybe doesn't have to be left to an individual other than for him to talk about what he sees in his local market relative to what the larger data set is saying. But the question we talked about a little bit earlier, Audrey, was that, you know, which you raised a good point, actually, which is, all right, let's say that, you know, we're doing an appraisal today. And we look at it compared to 90 days ago, probably in many markets, the prices have come down. The list prices have come down and some of the sales are starting to show some reduction. Is that a declining market, or do we go back 12 months
right,
and say that we're actually there?
Right.
And while there is no, that I'm aware of, and, you know, maybe we should have maybe even somebody who's a little more in the weeds on the appraisal side now than Mike and I both are. But is there, I don't think there's a definition that is clear related to that particular box that you should be checking. So to the appraisal community, who should know how important every transaction is to a homeowner in terms of if they're engaged in a contract to buy, then you better do your work to make sure that is a reasonable transaction and provide a fair and transparent value to them. And explain to your users, if you make a determination that you have to check the declining box for whatever reason, then you need to explain to your users that it declined over the last 3, it's actually ahead. You might check both boxes, you know, to declining and stable, or, you know, and explain it's been declining, but overall for the year it's up. And all of that communication, I think, will help underwriters feel comfortable with the given risk, given the credit side of the transaction.
You know, this kind of ties into the discrimination in appraisals. When, you know, before, an appraiser might write down this is a high crime neighborhood, and now he will write, you know, there is this much crime in the neighborhood, like actual percentages. Am I correct on that? Revisit how they do it now. And you could easily do the same thing with, you know, is this a declining market or not? Just relay the stats. Market is up, you know, 2% over last year, up 3% over last year, up down 1% from the last 3 months, down, you know, and it could state like government data. So that's much more, much better, more official way of doing it, more clear to everybody.
I would like to say that this should not be subjective. This should not be something that varies from appraiser to appraiser. I believe, actually, the more I'm thinking about it in this, you know, huge amount of time since this morning that this has popped into my head, that this should be something that maybe the Appraisal Institute is, maybe you do it. Maybe it's published.
Why doesn't the GSEs do it, for God's sake? They have all the data. They're taking all the risks.
How about this? How about
let the Fed do it? The Fed has a ton of economists. Let them, you know, indicate.
It's fine, Paul. I don't care how you do it, okay? The logistics don't bother me at all. You handle that, all right? So you get it for the GSEs. You get it to your appraisers, or all of the appraisers, because again, like, this is a big deal. This declining market thing, which, you know, if we're starting to see people say that, you got to be careful with it, because there's a big difference between a market going from 30% appreciation to, you know, like even flat appreciation. That's not declining. That's adjusting, right? That is the market adjusting to even a new normal. So, and also when you have list prices and price reductions, we still, you know, how we all know, any of us who've been through these cycles, you know, that happens in every one of these cycles, because you've got that disconnect between buyers and sellers. So the sellers still think they should be able to put their place up for sale, and then it's going to go for 300 grand over asking, or 5 if you're in Oakland and you're one of those. And that's normal, right? So they're insisting on a sales price. You've got wishy-washy people perhaps accepting that as a sales price and listing in that way, but whatever. And then you've got the buyers who think, oh, well, I'm in charge now and I'm going to lowball the crap out of it. So this has to work itself out. And we're in that period right now, right? So it's not fair to call it declining as we're like hashing that out once we get to a more normal market. So again, on the appraisal side, where these guys have been people have been so independent, like we were, like hands off, whatever they say goes, et cetera, et cetera. I think there needs to be some discussion with the appraisal industry as far as how to handle this, some direction from, and which leads to a whole nother thing, which is there is no national oversight. This is also something I've recently become aware of because of you guys. There is no national oversight over appraisals. It's all done at the state level, and it's very inconsistent from state to state. Is that a fair characterization?
Audrey, let me add a note of caution here to all of this.
Okay.
There's a danger with asking or expecting the feds to impose conditions on whether or not a market is declining, because they'll look at much larger patterns, and all real estate is local, right?
Yes.
It really is local.
Yeah, totally.
So the best judge of that data, that information, is your local appraiser who lives in that market, who sees what's going on. I saw a couple of comments flash across the screen, which actually highlights something that I was going to add to this discussion about listings. And I think one of the comments was that listings don't really reflect the market, sale prices do. Well, that's kind of yes and no. First of all, listings tend to be the canary in the coal mine, right? Real estate agents are savvy enough to know that in a market that's thinly traded, where prices are going up, if they price something lower, it's going to engender an auction-like mentality. Yep. Prices get bid up, and there's a feeding frenzy.
Right.
In markets that are lower, if you overprice a listing or you price a listing too low, you're going to invite a frenzy, but it's going to be to the lower end of the spectrum.
Yep.
Right. So listings have historically, except for the last 10 or 15 years, which have been kind of their own, serial market anomalies, I call them. Excuse me. They have always represented what somebody believed was a relatively fair market price for a particular property. So they've morphed in the last 10 or 15 years. The challenge is, if you're a buyer and you see a property that 3 months ago sold for $500,000, a similar property, and now you see a similar property being listed for $450,000, are you going to go bid $500,000 for that house? No, you're not. You're going to try and buy it for $450,000 or less. Yep. And in fact, it's the same analogy. If you could buy a car for $50,000, now all of a sudden that same car is for sale for $45,000. You're going to look to take advantage of an opportunity.
Right.
And in fact, those create dynamics in the marketplace that are, that as mortgage brokers, you bring a real value, because you can tell your customers what markets are doing. You can support them. And sometimes sellers have one agenda, buyers have another. The markets tend to find what that equilibrium point is. So it's, there may be a little bit of truth in everything, but sometimes you have to look at what the deeper truth is.
So Michael, the suggestion with the GSEs providing the information was not so that you get a broad national decision on values. It was literally like, they have that for most neighborhoods, right? So
no, they do, and we've asked. Listen, we have asked.
They won't
asked about that. First of all, they won't provide it because it's proprietary and it allows them to maintain a stranglehold. Secondly, I've asked them personally if they would release the CU data, like they had to do for lenders when they first
hold.
came out with collateral underwriter.
Please hold. CU data. What is that?
That's all of the information based on the loan submission, the information about the borrower, about the collateral, about everything, right? It's all that information. When they first did that and based their decisions on waivers and the quality rating for that particular property, they didn't want to release it to lenders. And in not doing that, lenders built up a big distrust about it. So they tended to not want to use it. And so the GSEs were forced to kind of release it to lenders. I've asked, and many others have asked, and probably Paul's asked too, for the GSEs to release their appraisal data to at least the AMCs, and they should release it to the appraisers. Their response is, and it's an old response, if we release it, appraisers will craft their appraisals so that they agree or share our perspective, and we don't want that. We want their independent perspective. Well, there's a technical term for that kind of thinking. It's called bullshit. It just doesn't wash. What they're worried about is if when they give a list of 32 comps in your CU findings, right? They're concerned that an appraiser is going to look at the first 4 comps, use those 4 comps in doing their appraisal, and then put their hands up and walk away. Well, first of all, if that's their worry, all they have to do is jumble the comps in their sequence. Doesn't matter to them. They already know what they chose. They can put them in any order they want. It'll tell you who's going to pick the top 4 because they'll not be in any normal sequence. But the fact is, that's the same argument that 25 years ago, the mortgage insurance companies used and the credit insurance companies used when they had laws that said you could not disclose your credit score, the credit score, or you, I like Jill's answer. You couldn't disclose the credit score to your borrowers, because if you did, it would be unfair. They would change their behavior to get better scores. Well, I'm sorry, but
right.
That's information in their
Isn't that kind of the point? Like, yeah.
And so we want to make them better.
Right. Totally.
We want them to be healthier contributors, right?
Oh my God.
It's the wrong argument. They're the wrong arguments.
Yeah, exactly.
The
I think again,
reason they don't want to release the data is because they release the data, we all know they don't know what the hell they're doing with it. So
that's right.
The last thing they want to do is let us look at the data they're using to waive the appraisal.
Right. Holy guacamole. Okay, so there's a question here. Are they collecting quality and condition data from individual homes? That's a good question too, because again, it seems very subjective, and I don't know how you would not make it subjective on any level, but how does that work, if you know?
Well, they do. I mean, several years ago when they were putting the UAD together, they—
Wait, please hold. UAD?
Uniform Appraisal Data Set.
There you go.
Which is submitted as part of the CU submission package. But they standardized quality and condition and developed a set of standards that appraisers can use. But it's well known that it's not very effective, meaning that appraisers, still have that subjectiveness that I can rate it a 3 or a 4 and somebody else rates it a 2 or a 3. And there's so many different economic stratas that they're trying to overlay the same 5, rating systems for these 2 major, which are critical. Quality and condition of a property is a big deal, right? And so, they're collecting some, they use it. I'm sure they're building it into their algorithm somehow. We don't know, non-transparent. But it's not as descriptive as an appraiser is going to be when he's looking at the MLS photos and he's comparing one comp to another comp and understanding the difference between quality and conditions. They almost have to go back and look at the photos themselves because the appraisal community's categorization of these things is not really standardized.
Okay, so basically how I'm feeling right now is I feel the same way about the mortgage industry and underwriting guidelines, et cetera. We need to throw the whole thing up in the air and start over again, because again, there are huge changes going on. There's all this modernization that's supposed to be happening, et cetera, et cetera. But is it effective? Are we addressing what needs to be addressed, et cetera, et cetera? Because, you know, again, we've always griped about appraisals.
Oh, well, no. Right? We don't always gripe about the appraisals. We only gripe about them when they come in low.
That's okay. That is an excellent point. Excellent. Okay.
Then that rolls into my next question. So, you know, I try to explain to my clients when we're ordering the appraisal and they're worried about the value. There's 4 outcomes if it doesn't come in higher, if it doesn't come in at value. You know, the first option, let's say it's, you know, $500,000 purchase price and it comes in like, let's say $450,000. So you can contest the value and, you know, go back and we can talk about the contested part, and maybe you get lucky in it. The appraiser agrees with the argument that you do. And that's one of the things that we were talking about this house. Some loan officers don't even know they can contest an appraisal value. Yeah, that's right. You know, it's like, wow, how did you not know that? But okay.
And some AMCs don't allow it or don't support it.
Yeah, it's not, oh, well.
Yeah.
But anyway, you can contest it. And I say, you know, there's about a 1 1/4 chance that it'll come into what value. And then the next option is, well, if it doesn't come in, maybe we can get the seller to come down. That happens, surprisingly enough, once in a while. They will agree, oh, you know, hey, we were really surprised we were going to get $500,000. We really thought it was only worth $450,000. You're right. We'll drop our price down to $450,000. Sometimes they'll meet in the middle. Then sometimes the seller or the buyer will say, you know what, it's still worth $500,000 to me. I'll pay the difference, right? And then the other option is the deal falls out of contract. Of those 4 options, 3 of them close the deal.
Right.
Even when the place doesn't appraise.
I think that when we're in this market, it's different than a year ago, where if it came in low and you wanted to buy it anyway, because you knew in 3 months the value would catch up with whatever you paid. Now, and you didn't have a lot of options. Now you have more options. It all depends on the market, right? Like what seems appealing to a buyer first, you know. And so that was well done, Kevin. We always give Kevin, you know, props when he comes up with something that's super good. Yeah, he has his moments. We like to highlight them.
I do want to take this opportunity to thank the experts in the room, because this happens every so often. A purchase price will come in like, it's a $500,000 purchase price, and it'll come in like $4,000 under. Oh,
that's just being that's the appraiser being a jerk. Just to summarize, from my perspective.
I have my own theory behind this, but I want to hear from the experts. Why does that happen?
That's a great question, actually. Okay, yeah, take it, guys. Tell us.
So I think Audrey's probably as close to the mark as any. You know, it's an appraiser being a little bit too fine in general. There may be some structural reason that they've tried to find a way to get closer to what the sale price is, but and they may have pushed the envelope as most that they could. But anybody that's within a couple of $1,000s on a normal transaction is, you know, there's a generally accepted range that you're looking at. So it's just a little weird. But I want to go back to something that Kevin said, and your definition, Kevin, of the 4 things that can occur is great. But I just want to remind people of a couple of things. Appraisals don't come in low. There's no such thing. They come in at that appraiser's opinion of value. That's what it is. Now, It may not agree with what the seller wants. It may not agree with what the realtor was hoping for. It might bring a smile to the borrower's face, but it's not low. It's just the value that they came in with. You're exactly right. Reconsiderations of value are an important part of the process. I think Paul does the same thing that we do. We tell our appraisers, this is an opportunity for you to help everybody understand how you arrived at your conclusion, support your value, or if the information that they provided causes you to modify it, please do so. We don't take points off for changing your value if it's a justified change. we only take points off if you try and say things like, well, I picked the best comps. That's just stupid.
Yeah.
We didn't pick the worst
wanna,
comps in the first place. So
I just want to give everyone a little tip on that. So it's best, and I know this from personal experience, to not send an email to your appraisal department thinking they were going to just digest your information and comment on it, but instead forward it to the appraiser, where the first sentence is, I think the appraiser needs a hug. That does not go over well. And in that light, again, I would know this from a personal experience. So make sure that when sending said reconsideration of value request, that you know exactly who it's going to, et cetera, and what they're going to do with it. So, and I want to take a minute. Oh, go ahead, Kevin.
I was going to follow up with my theory on it, Michael, and follow this, that when this happens, it's usually because someone stood up the appraisal for an appointment and either rescheduled it 3 times or showed up late when the appraiser arrived early. And that's the appraiser's way of giving a little bit of a dig, saying, hey, don't screw with me, I can screw with you too. But that's just my own personal.
I mean, not that they're passive aggressive.
I have a little bit different slant on, you're talking about the coming in close to sales price, missing by a few $1,000s.
Yeah.
It's a huge topic. And it's being used currently almost as a weapon against the appraisal industry right now, meaning that
because I actually liked Michael's answer to it about how he tried to get it as close as he could and he wasn't able to get it any further. I like that answer personally. But
so the weaponization that I'm referring to is if you read some of the literature that's coming out of those organizations that are interested in this, Fannie, Freddie, the Federal Reserve, they're writing papers. There's a lot of dialogue about how appraisers are just form fillers, box checkers, and they just always hit the sales price. Mm-hmm. So I can't tell you how many different statistics I've seen recently that say that appraisers, 90-some%, they just hit the sales price. And so when you think about it from a theoretical perspective, the sales price and the appraisal should almost never come in together if the appraisal process was truly independent and they're trying to get a value versus match the sales price. Mm-hmm. So fundamentally, our profession is still stuck, 100 years ago, where we are working for lenders and our job is to confirm whether the transaction is a good loan or not, as opposed to we're really actually supposed to value it at what we think. How do we get there? They're not 100% certain. I mean, there's a lot of people that say, well, if we're 4,000 apart, why does the borrower why can't we just adjust the loan a little bit? Or why don't we just say it's close enough and we'll make the loan at 20% down and we're good at the original sales purchase contract, right? Mm-hmm. That could be a securitization, a GSE change that would solve this 100-year-old conflict that appraisers are having with lenders over whether or not the sales price needs to come in at the penny or the appraisal needs to come in at the penny, because that's intuitively doesn't make sense either, right?
Yeah.
There's one of these, you mentioned bias earlier, Kevin. There's a great study. I want to say it was one of the GSEs that published it. I can't remember which one, but it's how appraisers are coming in below sale price more often for minority borrowers, mm-hmm. right? Now that headline indicates that somehow we are racist and that somehow we're harming minority borrowers more by coming in below sale price more often. Now, what if I told you that in fact, the data showed that minority borrowers are being taken care of, are being predatorily taken advantage of by people. They're trying to sell them properties that at prices higher than what they should be. And therefore, we should be coming in below the sales price more. What if that were the facts? Yeah. And we don't know the data sets, and they're using these arguments to attack what they refer to as bias of all kinds, not just racial bias, but unintentional bias, anything that they can put a bias around, we're being accused of it. Yeah. And all I can say to all of you who buy into any of those arguments, imagine a world where there are no appraisers and the value of things no longer matter. We don't want to go there.
Okay,
Well,
so I'm just going to say
yours.
the bias thing is an entirely different conversation. Yeah. But that is mind-blowing, honestly. That is a mind-blowing perspective. I mean, I literally need some time to digest it. What I want to do before we run out of time, which is going to happen sooner rather than later, is Michael, can you please tell everyone what you have been doing on the, he realized there was an issue with appraisers ghosting their clients, I guess is the word. We've all had it. We've discussed it on here before, where, you go to get a condition and the appraiser doesn't exist anymore. You can't get the condition. So Michael's been working hard on this. I want you to talk about that, Michael.
So I'll try and be as brief as I can and as clear as I can. And it's a challenging subject. But I belong to an organization as an affiliate, the Association of Appraiser Regulatory Officials, AARO. And it's a conglomeration of all the state regulators in all of the states who have the authority to discipline both appraisers and AMCs, by the way. And they're the only entity that has that authority. They license appraisers, they license AMCs, and they have the ability to discipline them. Federal government currently does not have any rules that allow them to do that. They have ceded that authority to the states. The problem is, in terms of ghosting, which is what too many of us have experienced, even if it's only a couple of times, an appraiser just abandons an assignment. In some states, you can't even begin to work on getting a substitute appraiser until you can determine, or that deadline is already passed. I mean, it's a convoluted mix and mess of rules and regulations from state to state. But to the point, for the last year and a half, I've been working with a number of people to try and get the state regulators across the board to find the one tie that binds all of them together. And it's USPAP, the Uniform Standards of Professional Appraisal Practice. Every state uses that as the Bible. And USPAP comes from where? Comes from the Appraisal Foundation, that non-governmental organization that somebody gave the rulemaking authority to.
Congress, Congress,
that's right.
By the way.
That's right, which is now starting, which is causing a real Donnybrook in arguing what should be done about this, because there are a lot of things that they're not happy about. But so it's a challenging problem, and I think we have a solution for it, how to address it. And if we did, it would allow the regulators to say, look, if you abandon an assignment, you typically can cost a borrower at least a lock extension fee. At worst, they'll lose the transaction. Sometimes they'll lose their deposit. The realtor will lose that purchase transaction, and the borrower and the loan officer will lose that loan. And there's really no recompense. You guys have, as mortgage lenders, you have a whole panoply of rules and regulations that you have to abide by. The real estate organizations have funds that you can attach for when their clients have been damaged. There's nothing for appraisers, and it's just wrong. It's just wrong, and it gives the wrong impression to the public. It damages your customers and you, and that's not correct. Even as AMCs, the worst we can do is stop using that appraiser, but they can work for another 300 other AMCs.
Right, and that I think is the benefit of having something like NMLS, which is not a licensing entity. It is a keep track of us entity, and there's value in that, because then you can't have a loan officer who goes from one place doing bad acts, and then when they get caught and shut down, they can go somewhere else and do the same bad acts. We need something, I think, similar for appraisers, so that they can't go from one AMC to the other, or 30 others, with nobody knowing what they've done previously.
And interestingly enough, Audrey, DC last year implemented the NMLS system for registering appraisals in DC, Washington, DC. And my bet is that they're going to try and replicate that across state lines. Now, there'll be states that will resist simply because states resist things just ad hoc. Yeah. But I think it's one part of a solution. It won't solve the fundamental ghosting problem, but I think we're getting closer to solving for that.
That's awesome. Okay, we have run out of time. I cannot thank you enough. I feel like this was a very different conversation than I've heard other places, which is, I think, beneficial. I would like to, at this point, give Paul a little halo to wear for the rest of the day, because he did great. I'm so proud of you. But in all seriousness, you guys are just gems in the industry, and we're so appreciative for all of your hard work. They are everywhere, guys. They are out there fighting for all of us and our borrowers all the time. And not every AMC does that. Not every appraiser is interested in what is good for everyone. They're focused on themselves. And these guys are the opposite of that, both of them. So for that, we thank you from the bottom of our hearts. And we know this discussion was not everything, but it is a start, and we'll keep them going. Okay. Anything you want to add to finish up, guys?
Yeah, Audrey, look, I'm more than happy to answer any questions. So if you want to post a way to contact me, that's fine. And if Paul won't do it, people can call me, and I'll give you Paul's number too.
Yeah, I'll give you Paul's number too. We're going to put it on the bathroom wall. That's a perfect place for it, right?
There you go.
That's right. No, you guys are wonderful. Michael Simmons with AXIS Appraisal and Paul Chandler with Property Sciences. They're very open and available for any.
I'd like to finish up with one comment, Audrey, because you and I have talked about this, is that I believe that the National Association of Mortgage Brokers and one or more of the appraisal organizations are out there need to work closer together moving forward, because DC is all about numbers. We are the closest to the customer. It's our job. We're, by Congress, authorized to protect public trust, and there's a whole regulatory structure in place. It needs work and it can be better, but we're in place. You guys have been around for a long time. We need mortgage brokers. The last thing we want is one or two sources of funds.
100%.
You know, showing homeowners that they have options, that there are choices to take. Yes. And then having a fair appraisal around that is everything for a homeowner. And we got to do a better job working together in DC to make sure that homeowners are protected and that our professions are given the respect that they deserve.
Well, my term with NAM starts October 1st officially. I am the includer. I am the person who's like, I know you hated them before, but can't we just get along now and work together for the greater good? So I am that voice. I am often the only voice that is messaging that. So we'll see how I do. But I agree 100%. We need to work together. It is very important, because no algorithm on earth is ever going to be able to determine the value of a view or many other things in an appraisal. And so it is really important that we are all on the same team. And with that, thank you to Kevin Casey, Michael Simmons, Paul Chandler. And I think that this will be on YouTube shortly. So stand by for that if you want to see it, or send it to your friends. And we'll see you next Tuesday. Next Tuesday, we have somebody coming to join us who is so brilliant with marketing ideas. It will blow your mind. So we'll look forward to seeing you then. And with that, have a great week, guys. Thank you.